The economy looks strong, but people don't feel it. Picture this. It's 2024. Unemployment is near historic lows. Stock markets are hitting all-time highs. Corporations are reporting record profits. By almost every official measure, the American economy is firing on all cylinders. But walk into a coffee shop. Someone's worried about rent. Someone else is deciding between medicine and groceries. A third person just got a promotion, but their paycheck barely stretches further than it did 3 years ago. So which reality is true? Both. And that contradiction, that gap between what the headlines say and what people feel, that's not a glitch. It's a feature. Understanding why will fundamentally change how you think about money and the invisible forces reshaping your life. How the numbers got disconnected. The problem starts with how we measure the economy. When economists say it's strong, they're looking at GDP, gross domestic product, the total value of everything produced in the country, and yes, it's been growing. Roughly 2 to 3% annually. Sounds normal, but here's the trick. GDP doesn't care who's earning or where the money goes. Imagine 2 scenarios. In one, 1,000 people each earn an extra $1,000. $1 million enters the system. In the other, one person gets an extra $1 million. GDP grows identically. America has increasingly been scenario 2. Since 2008, basically all wealth gains have flowed to the top 1%. Meanwhile, the median worker has seen wages increase 30% over 20 years, except inflation was 40%. Do the math. Your paycheck is worth less in real terms than it was 2 decades ago. You're earning more dollars, but they buy less stuff. And before you blame your employer, they're often following rules set by private equity firms trying to maximize quarterly returns. Those firms are owned by investors in pension funds. So in a weird way, your retirement fund is asking your employer to squeeze your wages. It's a closed loop that captures value from workers and redirects it to capital owners. This is the first invisible mechanism. The economy can be strong while you personally feel poorer. The housing trap houses are supposed to be where your wealth lives. You pay a mortgage. You build equity, you retire and downsize, except something broke. In 2008, investors realized if they bought cheap houses and rented them out, they could make guaranteed returns, better than stocks. People need somewhere to live, it's not optional, so they did BlackRock, Invitation Homes, American Homes for Rent. By 2024, institutional investors own roughly 7 million single-family homes in America, not apartment buildings, homes with yards in neighborhoods. Here's what happened. Rents went up, way up. 30, 40, 50% in some markets in just a few years. Someone making $50,000 a year used to rent a 2-bedroom for $1,200 monthly, 29% of income. Now that apartment costs $2,000, that's 48%. And if they try to buy, that house that cost $300,000 8 years ago now costs $600,000. To afford that down payment, 20%, you need $120,000. A person making $50,000 would need to save every penny for 8 years without spending anything else. Just for the down payment, where does that extra rental money go? To investor funds owned by the same people whose stock portfolios are hitting all-time highs. The same top 1% who captured all the wealth gains. The person trying to build a life, they're trapped. Rents consume more of their paycheck every year. Saving for a down payment is mathematically impossible. Home ownership becomes a luxury good for people who inherit money. The wage illusion here's where it gets absurd. Headline inflation, what you actually experience with gas, groceries, rent, peaked at 9% in 2022. Brutal, but by 2024, headlines say inflation is under control, 2.9%. What changed? Energy prices came down. Gas fell from $5 back to $3. Energy makes up a significant portion of the inflation basket, so the overall number dropped dramatically. But the things you actually spend money on didn't drop. Grocery prices went up 40% and barely came back down. Rent stayed elevated. The Fed claims victory. Working people still feel crushed. And then the Federal Reserve raised interest rates from basically 0 to over 5%. Their reasoning, high inflation requires reducing demand. You do that by making borrowing expensive. But here's the dark arithmetic. Higher interest rates mean higher car payments, higher mortgages, higher credit card payments. Companies make less money, so they lay people off. The economy cools. People spend less, prices stabilize, it works. Inflation comes down, unemployment stays low, barely. The Fed claims victory, but people who got laid off don't feel victorious. People with old mortgage rates at 3% can't move because the new house requires 7%. So they stay. The housing market freezes. People stop moving for better jobs. The labor market becomes gridlocked. The job market looks fine statistically. It's actually frozen. The credit card paradox: American credit card debt is at an all-time high, over $1 trillion. People aren't reckless. They use credit cards for groceries, car repairs, medical bills. Their paychecks don't cover their lives. Someone making $35,000 a year with $5,000 in credit card debt pays roughly $75 monthly in interest alone. $900 a year that goes nowhere. Doesn't buy anything, doesn't build anything. It's the tax you pay for not being rich enough to have cash reserves. That's the genius of the system. When you're poor, everything costs more. You pay more for credit, you pay more for everything. When you have money, money comes to you. When you don't have money, you're charged for the privilege of borrowing it. The stock market goes up. Corporate profits are strong. The Fed keeps rates high to protect stock values, and working people slowly drown in consumer debt. The economic statistics, still strong. Credit card spending is up. GDP is up. People are buying things they can't afford. The economy looks fine from 30,000 feet. It's destroyed at the individual level. Why wages stopped mattering after World War II. Roughly 35% of American workers were unionized. When companies tried to cut pay, workers pushed back collectively. Wages grew with productivity. When the economy got stronger, workers shared in the gains. Then something changed, systematically, deliberately. Starting in the late 1970s, corporations began weakening unions, not overnight. But through legislation, through outsourcing, through cultural shifts that repositioned workers as commodities. By 2024, union membership is around 10%. As unions collapsed, so did workers' share of economic gains. All productivity improvements went to capital owners and executives. A CEO in 1965 made 24 times what a median worker made. Today that ratio is roughly 400 to 1. When workers have bargaining power, they capture some productivity gains. When they don't, all of it goes to owners. The economy was deliberately restructured to eliminate worker power. Yes, unemployment is low, but that's because most people can't afford to be unemployed. They need the job more than companies need any individual employee, so raises are minimal, benefits shrink, pensions evaporated decades ago, the employment numbers look good. The power dynamic is devastating. The asset inflation trap: the Federal Reserve manages the economy through the wealth effect. When you see your stock portfolio go up, you feel richer. So you spend more, the economy stimulates. The Fed inflates asset prices using low interest rates and quantitative easing, buying massive amounts of bonds to keep prices high, and it works, sort of. People who own assets feel wealthy, they spend more. But here's the catch: half of all stock market gains in the last decade went to the wealthiest 1%. That 1% saves rather than spends. When they get richer, they invest more. Wealth concentrates further. Meanwhile, everyone else watches house values go up. Great if you sell. Terrible if you're trying to buy, and they get zero wealth effect boost. Their house is worth more, but they can't do anything with that value unless they sell. So the government inflates asset prices trying to stimulate spending, but it mostly just makes housing and stocks unaffordable for normal people. The gap widens. And everyone's confused about why they don't feel stimulated. The service economy trap: as manufacturing left America for cheaper labor elsewhere, the jobs that remained were increasingly service jobs. Retail, hospitality, food service, delivery, care work, these can't be outsourced because they require physical presence. They also have something fundamental in common: they don't pay much. Don't offer benefits, are often part-time to avoid healthcare costs, offer zero advancement. Someone in 1975 could get a factory job, join a union, make middle-class income, and retire with a pension. Their kid could go to college or learn a trade. Upward mobility was real. Now that factory job is gone or replaced by a logistics job paying $12 an hour. The person works full-time and still qualifies for food stamps, can't afford college. They're trapped. The economy adds hundreds of thousands of jobs monthly. Great headline. But those jobs are lower quality and lower wage. Companies know if they don't hire you, someone else desperate will. So they hire at $12. You need the job more than they need to pay well. The demographic weight: there's one more piece to this puzzle that rarely gets discussed. The demographic timeline is working against working people right now. Baby boomers are retiring. Millions of them, and they're living a long time. Healthcare is expensive. Long-term care is expensive. The system needs to fund this somehow. Social Security is partially funded by payroll taxes from current workers, but there are fewer workers per retiree now than there used to be. In 1965, there were about 5 workers for every retiree. Today it's about 3. In 20 years, it'll be closer to 2. The math doesn't work. Either benefits need to drop or taxes need to go up, probably both. Meanwhile, young people are crushed by student loan debt. Average is over $30,000 per borrower. College costs have gone up roughly 8 times faster than wages. So we have an aging population that needs care, a working-age population already squeezed, a younger population starting out 3 decades behind on wealth because of education debt. The system can theoretically handle this, but it requires difficult choices. It requires admitting that some of the gains captured by the top 1% need to be redistributed. It requires changing how we organize work and compensation. Instead, the current plan is keep the stock market strong, hope productivity keeps growing, and deal with consequences when they arrive. The cognitive dissonance, so let's go back to the beginning. Why is there this gap between what the numbers say and what people feel? It's not that the numbers are wrong, they're accurate. GDP is growing, stock market is up, unemployment is low, corporations are profitable, but those numbers measure something very specific: total economic activity and asset values. They don't measure whether that activity is distributed sustainably, don't measure whether people feel secure, don't measure whether the game feels fair. Here's what nobody talks about: the game isn't supposed to feel fair to most people right now. The current economic system is working almost exactly as designed. It's creating wealth for asset owners and keeping worker costs low. It's growing overall, which creates the appearance of success. But it's not distributing gains in a way that creates security or mobility. A CEO freezing wages and buying back company stock isn't greedy. That's rational capitalism. A private equity firm buying housing and raising rents isn't predatory. That's how capital maximizes returns. The Fed inflating asset prices while keeping wages suppressed isn't sinister. That's just monetary policy, but the cumulative effect of millions of these rational decisions is a system that feels increasingly rigged, and people feel it. The unresolved question, so here's what I want you to think about, not as an economic student, not as someone trying to get rich, but as someone who lives in this economy. We measure economic success by whether the overall pie grows, GDP up, stock market up, corporate profits up. The pie is bigger, but what if the question we should actually ask is, who gets a piece? Right now we have an economy that's growing, but growth is being captured by people who already own capital. We have low unemployment, but available jobs don't pay enough to build lives. We have record stock market highs, but that wealth is locked away from most people. The Federal Reserve, the Treasury, financial analysts, they're optimizing for metrics from a different era. Looking at GDP instead of median wages, asset values instead of who owns them, employment instead of employment quality. It's like measuring a restaurant's success by how much food arrives in the kitchen without measuring whether people get fed. You could have tons of food arriving daily, the kitchen busy, money flowing in, but 90% of the food goes to owners and customers starve. On paper, that restaurant thrives. In reality, it's a system that extracts from the people it serves. The economy might be strong, but strong for whom? And for how long can you build a stable society where most people feel like they're losing ground, where people work full-time and can't afford basic dignity? Where a single medical emergency destroys your finances? That's not rhetorical. That's the question defining the next decade, because sooner or later these two realities collide. The official story and lived experience, and when they do, it won't be statistics that matter. It won't be what the Fed says. It'll be what people believe about fairness, opportunity, and whether the system was ever actually designed for them. And that belief is cracking.